Good afternoon, everyone, and welcome to this webinar in our March event, A Feast of Ideas for Your ISA. This week we have an emerging market theme, and we'll shortly be continuing that by looking at India. We'll be hearing from Ayush Abhijit, a member of the investment team that manages Ashoka India Equity Investment Trust. Before we begin, just a reminder that we have roughly 30 minutes for the presentation and around 50 minutes or so for questions. If you would like to ask a question, please write the question in the box, which should probably be on the right of your screen, and then we'll put those to Ayush at the end. So with that, I'll hand over to Ayush.
Thank you, Thomas, and good morning, everyone. Thank you for joining us today for this discussion. My name is Ayush. I'll start with a quick background about who we are, what we do, give you a quick 2-minute overview of us, and then straight go into the India investment opportunity. The Ashoka India Investment Trust is managed by the White Oak Group, overall $5.5 billion of AUM. The fund was set up by the former Chief Investment Officer at Goldman Sachs Asset Management, who ran the India Fund as well as the Emerging Markets Fund at Goldman, spent close to 2 decades, and then started White Oak in 2017. We launched the Ashoka India Trust offering in 2018, July 2018, so almost just under 5 years now. And we started with a very different value proposition for our investors. We said we'll have 0 management fees, we'll only charge performance fee, and that too an outperformance relative to the benchmark, and we'll have an annual redemption facility at NAV. To our minds, this was one of the most shareholder aligned incentive structure compared to anyone else in the peer group. 5 years later, this is how we've done. If you look at the bottom left, since inception, all of these numbers are net of fees, net of all operating expenses, net of realized taxes. In sterling terms, over the last just shy of 5 years, the trust has compounded at 14.5% per year compared to 8.6 for the benchmark, with an annualized alpha of 584 basis points. It's a fairly strong performance. Now compared to the peer group, for the benchmark, the other 3 competing trusts in the market have done anywhere between 16 to 18%. So the trust has not only outperformed the benchmark substantially, but also the returns are anywhere between 4 to 5 times that of the peer group. And as a result, the trust has traded at a modest premium to NAV over the last 5 years compared to pretty much everybody else in the market trading at a low to mid-teens kind of a discount. That was the quick overview of the Ashoka Trust. As of today, this is how the portfolio is positioned in terms of our sector exposures. The top half gives you how we are invested across various sectors. Very well distributed portfolio. Financials is about 20%, technology 16%, consumer, healthcare, industrial. So we find a lot of very compelling opportunities across various industries, and just in a couple of minutes, I'll kind of elaborate on 1 or 2 of these interesting sectors where we are invested. Now let me talk about sort of India, the India opportunity. If we zoom out and look at how various economies have developed over the last sort of 40 years, this is how it looks like. China back in 1980s was the 9th largest economy. India was nowhere to be seen in 1980s and 90s, and China has gone on to become the 2nd largest economy over the last few decades. And now you see India popping up on the scene in the early 2010s as the 9th largest economy. 10 years later, India is now 6th largest economy, almost 3 trillion in terms of GDP, and it is projected that by the end of this decade, by 2030, it is going to be the third largest economy, and that encapsulates the opportunity that lies ahead over the next decade as far as India is concerned. Even compared to, if you look at how different markets have done, India versus China versus many other emerging markets, this is how the performance looks like over the last 5 years. MSCI India, the Indian index, has done just about 6% annualized dollar returns, whereas emerging markets and China have both underperformed. Even if we take a slightly longer term view, look at the last 10 years, again, you would notice that over the last decade, the Indian index itself has compounded at about 7% annualized, compared to 2% for the broader emerging markets and 3% for China. So what we saw here on this slide earlier in terms of how the economic evolution of the country is happening and has happened over the last 5-10 years, it is sort of reflected, translated into how investors have done in the equity markets. However, the most exciting aspect to our minds, of course, the index has done well and would likely continue to do well over the coming years. But what is the most attractive aspect to our minds is just the sheer alpha opportunity on top of the index returns. And let me take a moment to talk about this. What you have on your screen is a study, the results of a study done by Wall Street Journal. Wall Street Journal looked at some of the large equity markets globally. This study was published just before the pandemic. They looked at some of the large economies, equity markets, to figure out what are the markets where active investing works, and what are the economies, what are the markets where you are better off investing in low-cost index funds. And the results are something that we've always believed in for a long period of time, and is sort of validated by the study. And what you see at the top is that India is the most attractive market for active managers. Even if you're able to find the 50th percentile manager, they can actually add anywhere between 200 to 300 basis points of alpha on top of the index returns. India continues to be an inefficient market. It is perhaps one of the largest inefficient equity markets globally, and that makes it fertile grounds for bottom-up active stock pickers like ourselves. In fact, if you look at some of the other markets like US, you're better off investing in an index fund, as opposed to in India, where it makes sense to spend time to hunt for the right manager to invest with. With that backdrop, now I want to talk a bit about the macro environment in the country. And what we're seeing today is a very interesting sort of trifecta, which historically we've not found. One or the other has been missing. And these three pillars in the current macro environment are, number one, when we look at some of the fundamental indicators of the health of the economy, be it inflation, be it the crude oil prices, current account deficit, we are seeing a very benign macro environment in the country. Along with that, the banking sector is in perhaps the healthiest shape that we've ever seen. And the third pillar is that corporates, their balance sheets have been delevered over the last decade, right? And we'll walk through each of these pillars. But why this is important is that this makes for a very attractive combination in terms of the investment opportunity. And later we'll see how this stacks up relative to the earnings growth as well as the valuations at an India level. So let me start with the macro backdrop first. If you look at some of the key macroeconomic indicators, the top left is inflation and interest rates in the economy. The way to read this graph is on the dark blue line represents the consumer price inflation in the country. And what you would notice is that over the last 3 to 4 years, in stark contrast to what's been happening in most developed markets, inflation has been quite benign in India. It has remained anywhere between 6 to 7 percentage points, which is not very far from the long-term average inflation in India, which has been around 5-6%. So while most developed economies, be it US, Europe, uh, are currently grappling with substantially higher inflation relative to their own history, the Indian experience has been very different. We have not seen inflation really become a challenge. And this is a question that we frequently encounter as to what has led to this dichotomy between global inflation versus how inflation has played out in the country. And the answer there lies in here. If you look at India, US, and Europe, and what comprises inflation means different things to different economies. In most emerging markets, a greater proportion of inflation basket, the CPI basket, comprises of food. For instance, in India, about 39% of the inflation would be food inflation, whereas in US, Europe would be anywhere between 14 15%. India is self-sufficient as far as food is concerned. In fact, it is a net exporter. So while global supply chains went for a toss because of the Russia-Ukraine crisis, there was a shortage of food grains, and most economies had to import food grains from outside, had to pay sky-high freight rates because of container prices and shipping prices going through the roof. India was largely insulated because of being self-sufficient on the food side, which is a big part of the CPI basket. And this was one important reason why inflation remained under control. The second reason is at the bottom of your screen. If we take ourselves back to 2020, in response to the pandemic, different countries adopted different approaches. On one hand, if you recall what happened in the US government was handing out stimulus checks, right? And consumption stimulus is very inflationary in nature. It stokes inflation like nothing else. And on the other hand, if you see, uh, India took a very prudent stance to spending during the pandemic year. So in US, these are some numbers at the bottom of the graph. In US, almost 22% of all spending was in the form of consumption stimulus that stoked inflation in the subsequent years. Contrast this with India on the right hand side, only 3.5% of all spending that happened during the pandemic year was consumption stimulus. This is the second reason why inflation has remained fairly benign. And the third reason has got to do with the nature of the economy. The dependence on global trade is relatively low. What this shows you is the trade intensity, which is imports plus exports as a percentage of GDP. And that is relatively small for India, given the consumption driven economy that the country is. So, all of these three combined have led to what we see here, which is fairly benign inflation in the economy. India does not have to grapple with substantially high inflation compared to many other developed economies, and uh, that makes for very strong sort of macro indicators. The second worry that always investors have had about the country is what happens if oil prices go through the roof. India, of course, is a big importer of oil, and historically, if you go back 10 years, 20 years back, very high crude oil prices would have meant that the current account deficit goes for a toss in the country. That is slowly changing. If I can draw your attention to the graph at the top left, you see there's a dotted line. The dotted line represents what is that crude oil price at which the current account deficit exceeds 2%, assuming that 2% is that level beyond which it's bad for the economy. And you would see that this dotted line is slowly trending upwards. 20 years ago, at $40 per barrel, the current account deficit would have reached 2%. Today, it takes $85 per barrel. What this tells you essentially is that the vulnerability of the economy to energy prices, to crude oil prices, is structurally declining. And I cannot overemphasize this point, that the relevance of crude oil prices is slowly becoming lower and lower. And we can expect this dotted line to trend upwards over the next 5, 10, 20 years. And a big reason behind that is on the right hand side, that to counteract these large sort of import bills year after year, now we have got sizable exports that have emerged. Just one example is IT exports, which are just about $200 billion, enough to take care of the entire import bill for 1 year. And we've seen emergence of multiple subsectors that have reduced the relevance of raw crude oil to the economy. Now, I spoke about the trifecta. The first was benign macro environment. The second part of the trifecta is just the health of the banking sector. Banking is a large part of the economy. About one-third of the index comprises of the banking sector, and you need to have a very healthy banking sector in order for the economy to grow. What you see on the top right, on the right-hand side, is how asset quality has trended across the banking sector in the country. In the run-up to the global financial crisis, up until 2008-9, Indian banks at an aggregate level lent pretty recklessly to a variety of industries, including iron and steel, power plants, infrastructure, cement, so on and so forth. Many of those projects never really reached optimum utilization, and the banking sector was saddled with non-performing assets. And it has taken almost a decade for those assets to slowly go out of the balance sheet. Reforms have helped. India passed the bankruptcy reforms a few years back, and that has been instrumental in, in, in rapid cleanup of the banking sector. And what you see today is that the net non-performing assets in the banking sector is at a decadal low. And this in turn is now driving credit growth. The banks have the ability to lend to sectors that are in need of productive capex, capital expenditure, capacity expansion. And third, if you look at now the third piece, which is the corporate balance sheets. How is corporate India? What is the degree of debt levels on the balance sheet of corporate India? You see that corporate leverage tends to be a deep cyclical. Right? This essentially is the last 20 years of how corporate leverage has moved within the Indian economy. It bottomed out in 2006 and then almost for a decade expanded. And like I said, now for the last decade, we've seen companies take measures to clean up. Profitability has gone up. And today, as we sit in FY23, we are sitting at a decadal low as far as the leverage on corporate balance sheets is concerned. So when you combine the two, that from a demand perspective, inflation has been fairly benign. The banking sector has the capability to lend to sectors that really need debt to drive capital expenditure, and corporates themselves are quite unlevered and can take on debt to start productive capex, and that makes for a very compelling combination to our mind. Now, in the context of all of this, how has corporate earnings trended? The bottom left graph is what that tells you the earnings growth profile since 2000 to 1998. What you would notice is that India almost had a lost decade up. So from 2010 till 2020, you see the bars are fairly small. This essentially tells you that the earnings growth at a corporate level was quite weak. And post that, we have seen earnings growth accelerate. In 2021, this is March 2021 year ending, we had 14% earnings growth, which was followed by 33% in fiscal 22, followed by 12% in fiscal 23. So we're already at the end of March. Over the last 12 months, we've seen a 12% earnings growth. So the earnings growth has now accelerated to the best ever since 2004 as a result of what we have seen in the prior slides. And now you juxtapose valuations, country level valuations on top of this earnings growth profile. The graph at the top left gives you the history of valuations in the country at an aggregate level. While we've never been big fans of country level aggregate valuations, but for what it's worth, the forward multiples today are at 18.9 times. The average of the last decade has been 20.7. So compared to India's own history over the last decade, the headline valuations are about 10% lower, despite having substantially higher earnings growth profile, unlike what we have seen since 2004, 5, 6. So to summarize, the macro indicators look quite benign. Banking is in a healthy shape. Corporates are delevered. Valuations are relatively attractive compared to its own history, even as corporate earnings growth are accelerating, perhaps the best phase of earnings growth over the last 10 years. Now, with all of that, we are seeing substantial bottom-up opportunities across the market cap spectrum. And I said I will give a few examples of where we are finding attractive opportunities in India. And one of the places where we have found very good opportunities is private sector financials. India liberalized in 1991. Prior to that, the banking sector was pretty much all government-owned banks. So if you see the two pie charts at the top, on the left-hand side is how the banking sector looked like in 1991. SOE stands for state-owned enterprises. So 92% of the banking sector comprised of government-owned banks. You fast forward 30 years later on the right-hand side, private sector banks now are 35% of the broader of the banking sector. So after 30 years of market share gains from highly inefficient government-owned banks, private sector banks are at 35%. We have found a lot of attractive opportunities in select well-run private sector franchises in India. These banks are not only some of the best banks in Asia, but we think that they are also some of the best run banks anywhere in the world. On top of that, credit penetration itself offers a long runway for growth. So these private sector financials are not only gaining market share from highly inefficient government-owned banks, but also riding on the back of a large under-penetration opportunity in the country. Another area where we're finding a lot of attractive opportunities is on the consumption side. All of you are very well familiar with the consumption story. There's a large growing middle class. If you look at how the construct of the country is going to change in terms of the composition of the middle class, look at this graph at the top left. Today, if you look at the higher and the upper mid sort of income, only 24% of the households are part of this upper mid and high income households. By 2030, this 24% goes to 51%. So the size of the middle class is effectively doubling by 2030. And what we're also seeing is that many consumption categories in the country are at an inflection point because rise in disposable income has a multiplier effect on these consumption discretionary categories. Internet has democratized aspirations. So it's a very aspirational middle class. And now slowly the access is getting democratized too. And we are finding a lot of attractive opportunities in very different sectors, right from QSRs to clothing to automotive, etc. The investable universe itself is expanding with a lot of IPOs coming into the market. And on the right-hand side, you can just see a few examples. The franchises that run KFC, Pizza Hut, Burger King, Domino's, all of these are at an inflection point as far as consumption in India is concerned. And the third bucket where we are seeing attractive opportunities is on the technology services side. As I highlighted earlier, it's close to a $200 billion industry now. And Indian IT is gaining market share from global enterprises, global competition like IBM, DXC, Capgemini. On the bottom right, you can see the market share of Indian IT companies. In 2006, it used to be about 3%. Over the next decade till 2016, it went to 11%. Today, we are sitting at 13%. There are structural competitive advantages that these IT services companies have, and they have been rapidly gaining market share from global companies. These competitive advantages are in the form of supply of skilled labor, skilled talent at scale, at a cost-effective rate. We think that this market share of Indian IT, which is at about 13% today, can structurally increase to 20-30% over the next 2 decades. And within this, we have several attractive investment opportunities that are gaining relative market share within India as well. Healthcare, bottom right. India's healthcare spends per capita today is about $73 per capita. In UK, that would be about $4,300 per capita. UK's healthcare spend per capita is 60 times, 60-fold that of India. Even if you look at certain economies like Malaysia, Vietnam, they are anywhere between 2 to 6 times that of per capita spend in India. And what this tells you is that the opportunity in terms of various components of healthcare to grow is substantial. And there are 3 subsegments where we find opportunities. The first is around hospitals. It's a highly fragmented market. Large organized players account for just 2 to 3% of the total capacity, and the segment itself is growing at 12 to 15%. Diagnostics is another area where we're finding opportunities. Uh, it's a highly organized segment. Some of the largest chains in the country have low teens kind of a market share. The industry is rapidly formalizing. So a bigger trend in India is essentially formalization. Well-run private sector franchises gaining market share from the unorganized segment. And the third piece within healthcare where we found opportunities is in the pharmaceutical sector. While India generics pharma companies have a substantial market share in US. However, there are substantial pricing pressures. Companies are reprioritizing, and we have found more opportunities in India-centric branded pharmaceutical businesses that have focus on the faster-growing chronic segments, chronic therapies, as well as increasing their footprint outside of the US geographies. And the final example that I want to talk about is industrials. And this is something that is happening as we speak. It's happening now. Uh, COVID exposed the vulnerability of global supply chains to China. Countries realized that they were over dependent on one single country, and therefore they had to find credible alternatives. India has emerged as one of the most credible alternatives for supply chains, for manufacturing to move outside. And we are seeing that shift happen. COVID has accelerated that shift. Geopolitical issues have accelerated that shift. And the Indian government has doubled down on this opportunity by coming up with perhaps uh, the most important reforms in the industrial segment that we have seen in recent history. They've come out with something called production linked incentive, where there's an outlay of $35 billion targeted at specific industries like consumer electronics, semiconductors, automotive batteries. And the government wants to build global champions out of India. The government wants to capitalize and build the domestic manufacturing industry. So this is another area where we are seeing very attractive opportunities emerge on the back of both this trend of supply chains moving out of China, as well as the Indian government itself pushing through reforms that is helping this manufacturing industry to flourish in the country. And within this sort of the industrial bucket, another trend that we're seeing is indigenization. If you look at the defense sector in the country, it is highly dependent on imports. Right? Uh, Now the government is sort of doubling down on building domestic champions, indigenizing a lot of the defense imports, and reducing the dependence on international countries from where India historically imported. We are at the top of the hour now, so I'll quickly summarize and open up for questions. We think India is the most attractive market for active investing. And as bottom-up stock pickers, we find a lot of interesting opportunities to capitalize on this domestically driven growth. Uh, India has a very mature infrastructure for democracy, which means separation of powers between the judiciary, the executive, the legislative. There is a rule of law, respect for property rights. Uh, and the Ashoka Trust has a very strong track record of capitalizing on this opportunity on the back of a unique shareholder-aligned structure, as well as a track record uh, that stands out compared to the benchmark as well as the peer group. With that, I'll take a pause and open the floor for questions. Thomas, over to you.
Fantastic. Thanks, Ayush. We have quite a few questions already coming through, but if you're in the audience and you have questions, please do add yours. Perhaps we could begin on the fund, on the trust itself. So you had a couple of questions about the small and mid-cap focus. So can you give us a picture of where your allocation is at the moment and where it's likely to move to?
That's a great question. Thank you. What you see here on the screen is essentially the split of the portfolio across different market capitalizations at the bottom left. Today, about 40% of the portfolio is in large caps. And the way we define large caps is anything more than $6 billion, give or take, market capitalization is large caps. Mid caps are about 19%, and small caps are about 37%. So very well distributed across the market cap spectrum. We do not take a top-down view on what the proportion should be, but the long-term history has been large caps have been close to 50%. Half the portfolio has been in large caps, and the remaining half has been in mid and small caps. And the reason why we have greater allocation to the mid cap segment is because of greater inefficiencies in the market. We have 25 plus member investment team that is present on the ground in India, conducting primary due diligence, meeting companies, meeting competition, talking to management team, talking to suppliers, customers, distributors, interviewing ex-employees, and building a holistic 360-degree view of the competitive advantages, the governance DNA of a business. And that allows us to know certain businesses far better than our peer group, far better than our competition. India is a very fragmented market. There are about 4,000 plus listed stocks. It's a very fragmented market. We invest, our investable universe is anything that is more than $200 million of market cap. That means there are about 800 companies that are part of our investment universe. And out of those 800 companies, sell-side equity research exists only for probably the top 200 companies. So because of the fragmented nature of the market, sell-side research exists for only the top 20% of the market, top 25%. And beyond that, there's a lot of primary work that's supposed to be done, which means that it's an alpha-rich segment as well. And our on-the-ground presence helps us to extract a lot of alpha from this segment of the market. And that explains our structural tilt towards mid and small cap segments in the market. And these mid and small cap investments are distributed across the industries. So there is no specific industry segment across financials, technology, consumption, healthcare. All across the board, we have found opportunities in the mid and small cap segment of the market.
And you touched on the large analyst team you have. How does an investment decision get made then? Do you all have to come to agreement, or is there a final decision maker?
Great question. So this is the overall investment team at the White Oak Group, and out of this, 27 plus are dedicated to India. We also have a global emerging markets fund, so some analysts also look at the emerging markets piece. What stands out for us is that the typical structure in asset management is that you tend to have one portfolio manager at the top and a few analysts at the bottom. Each analyst covers one sector, and decision making happens fairly in a top-down manner. What we have is a very bottom-up sector-driven approach. So for every sector, there is a 3 to 5 member investment research team. And this 3 to 5 member investment research unit is responsible for everything, right from idea generation to due diligence to financial modeling to making the presentation to the broader team, investment discussion, and then finally recommending the position sizing and the eventual exit. So a lot of the decision making is actually driven by these 3 to 5 member research teams in consultation with the PM. So it's a very fairly distributed decision making structure as opposed to the commonly found top down, top heavy decision making structure that exists in asset management firms. What is also different here is that typically there's a one-to-one mapping in asset management, which means that one stock is covered by exactly one analyst. What we have is a one-to-many mapping, which means that one stock is independently looked at by multiple pairs of eyes. And this helps to remove any biases that might creep in, right? Any blind spots that analysts might develop. We want to get rid of all of these. So therefore, we have got one stock being looked at by multiple pairs of eyes for independent competing perspectives on the same business.
And sticking with stock selection, can you tell us a little bit about ESG and how that plays into your analysis?
Sure, great question. So first, I'll talk a bit about what the philosophy looks like and how sort of ESG fits into that. Our belief is that in order to earn outsized returns, you need to do two things right. You need to find great businesses, but then be very disciplined about the valuations at which you invest in these businesses. So we do not subscribe to the school of thought which says that once you find a great business, go ahead and buy it at any price and you'll do just fine in life. There's merit to that argument, but we think that in order to deliver peer leading performance, you need to be extremely disciplined about valuation. The first pillar is a great business. And what we think a great business should look like, it should have three key attributes. Number one, it should have the ability to deliver superior returns on incremental capital, which in turn is a function of the competitive advantage and the sustainability of that competitive advantage over time. The second attribute that we want is scalability, which means that does the business have potential to grow multifold over the next 3, 5, 10 years? And finally, does the business have an exceptional management team with a track record of execution and high standards of ESG? Once we find a business that has all of this in good measure, we move to the next step, which is assessing valuation. We have an in-house proprietary framework to assess value. We call it the OpCo-FinCo framework, and if you're interested, we can spend more time on this. But in essence, we do not look at accounting multiples like price to earnings or EV to EBITDA. What we look at is economic cash flows. And at the bottom of your screen, we look at price to excess return on invested cash flow, which is nothing but the market implied value of excess returns versus our own in-house measure of excess ROIC cash flows. One of the inputs into the terminal multiple that we ascribe is the ESG score that we calculate for any business. All else equal, a company with superior ESG score attracts a higher terminal multiple. In order to extract that ESG score, the team has built an in-house ESG framework. It's called the ABLE framework. What we realized was that in emerging markets, providers like MSCI, Bloomberg, Sustainalytics have very shallow coverage. And given that, and their coverage is also limited to only large caps. As you saw, we invest across the market cap spectrum. We realized that about 60% of the portfolio was not rated by MSCI. So we have built an in-house framework of ESG analysis and ratings called the ABLX framework, which looks at sector-specific hierarchy of ENS issues. There is sort of a flagging and scorecard, a multiplier system to arrive at an in-house score on various ESG parameters. We've got an in-house ESG specialist team that supports the sector-specific analysts to run this analysis. And that's how all of this feeds into valuation and ultimate decision making.
So turning to recent performance, I'll try and wrap a few questions together. So there's been a bit of volatility in the Indian market. I've had a question about how you explain that. How do you respond to that? And then obviously the share price of the trust is negative at the same time. So what's been driving that? And I think maybe if I could wrap one further question in, because I think it is connected. So could it possibly be that the fallout from the Adani scandal has been weighing on valuations, and do you worry that there's more to come in terms of that scandal?
Sure. So first, let me set the context of the question. If you look at the performance, you can also see calendar year-wise performance. 2019, there was 740 basis points of alpha. 2020, 13 percentage points of alpha. 2021, 16.8%. And 2022, we had negative 575. This year, we are again tracking at plus 297 basis points of alpha. So that was your question, pertains to calendar year 2022. You know what happened and why there was a small drawdown that we saw there. Now, the answer lies here. This is the summary of why this played out. When you look at the Indian market, one way is to look in terms of market capitalization, right? We are over-indexed to small and mid-cap segment of the market. The other skew that we have in the portfolio is a greater exposure to certain segments of the market. If you see, there are three colors on the screen. On the right-hand side, there's the green section, there's yellow in the middle, and red on the left-hand side. On the right-hand side, you have sectors that in general tend to have good governance, that are driven by business variables and are lightly regulated. These are industries like IT services, consumer goods, financials, consumer discretionary, and industrials. We tend to find a lot more opportunities in this segment of the market, the right-hand side. In stark contrast, on the left-hand side, there are certain industries like real estate, commodities, government-owned businesses that have, in general, poor corporate governance, that are driven by macro variables, which we don't think bottom-up stock pickers like us can predict. And these also need to be heavily regulated. This includes utilities as well. And we don't find a lot of attractive opportunities in the left-hand side of the market. In short periods of time, if the left-hand side of the market does exceptionally well, the portfolio tends to lag. And that's what happened in calendar year 2022. Some of the best performing sectors last year were utilities, commodities, real estate, and the portfolio does not have exposure to those segments of the market. Even the small and mid cap segment as a whole underperformed. In general, the stock selection alpha is sufficient to overcome these headwinds. Last year was an exception because it was a perfect headwind with all these factors working against us. So in a nutshell, that explains the alpha drawdown that we saw in calendar year 2022. The other question that you had, Thomas, is in terms of valuations and the Adani Group. While I will not sort of comment on any from a regulatory, from a compliance perspective, I'm not allowed to talk about specific businesses. What I will talk about is, in general, the corporate governance standards that you see here on the right-hand side. That's about 75% of the market. These companies tend to have very good corporate governance standards. In fact, companies in IT services, in consumer, have perhaps as good as corporate governance as you see in developed markets, right? So I would say that certain examples are not emblematic of how companies are run in the country. And there are more and enough high quality, well-governed businesses to choose from and invest from in the market.
On valuations, more broadly, so you showed the valuation of the Indian market, and you quite clearly showed that the kind of the drop in relative premium. This is largely due to the derating of China and perhaps a couple of other markets. Do you is there a danger that India then drops to meet them, or how do you see this developing in the coming years?
A great question, Thomas. So if you see on the right, on the first, let's look at what's happened on the left-hand side. Top left, you would notice that over the last, Indian valuations have not dramatically changed in the last 12, 15, 24 months. What has dramatically changed is the base against which it gets measured on the right-hand side. If you see, China got massively derated, and therefore, despite not going anywhere, the premium expanded. And then starting October last year, October, November, December, we saw a massive rally in China, right? Post-COVID reopening and all of that. And now the premium has come down. India's always been an expensive market. Over the last 15 years, the average premium relative to other emerging markets has been 40%. Look at the graph on the right-hand side. The dotted line is at 40%. So on average, it's at a 40% premium to other emerging markets for a variety of reasons. It has got to do with the quality of democracy, property rights, rule of law, the heterogeneity of the market. It's a consumption-driven market, right? The penetration opportunity, all of these factors imply that global investors are willing to pay a premium to invest in a country like India. Having said that, we believe that in the medium to long term, market returns would be in line with nominal GDP growth rate. So I'll wrap up with this. If you see here, this is the history of corporate earnings growth over the last almost 30 years. The market returns, there are three arrows, the market returns, the nominal GDP growth rate, as well as the earnings growth rate are identical. And that's what we would expect in India to play out in the medium to long term, that the index return would be in line with the nominal GDP growth rate of, call it 6% real growth or 7% real dollar growth. We don't know, but somewhere around that. If you're able to find the top performing manager in the country, they will be able to add sizable alpha on top of that. Right? If you recall this slide where we spoke about the Wall Street Journal study. So this is alpha on top of the index returns. The market should give anywhere between 5, 6, 7% dollar returns over the next decade. If you're able to find the right manager, they can add an equal amount of alpha on top of, because of the inefficient nature of the market. And that is the broad construct with which we look at the Indian equity markets.
Excellent. I'll try and get a couple of last questions in, if you don't need to rush. We had a couple of questions about politics. I'm sure it's not your preferred area, but Modi has some detractors overseas. Is there a danger that his politics comes to see Indian equities have a premium applied to them? Is it an extra risk that weighs on the market, do you think?
So historically, if you look at data, any particular political party being in power or not being in power has not had a disproportionate impact on equity market returns. In fact, if you look at the last 20 years and sort of break down equity market returns by various regimes that have been in power at the center, we have not seen any such evidence to believe. What is more important, Thomas, is that you need to have a strong majority at the center. Be it Modi, be it the other party, whoever comes at the center, if they have a strong majority at the center, it's easy for them to push through tough reforms. If you have a weak coalition at the center, then reforms take a backseat. So, to our minds, what is more important, regardless of which party comes to power, is the nature of the majority at the center. Is it a strong majority or is it a weak coalition? And it's the latter which the markets don't like. Now, having said that, India is due for elections next year. We are about 12 months away from central elections. The current party has won the last 2 elections, is up for the 3rd term. And the way things look like today, they have a reasonable probability of coming into power for another 3rd term. And if they come with a strong majority, they'll have the opportunity to push through some of the other important reforms, right, that we've been waiting for. And kind of what we want to see is policy continuity, which a weak coalition does not allow for. So markets don't like any particular party. What they like is policy continuity and a focus on reforms and good governance at the center. And that's what everyone would be watching out for in the election outcomes next year.
Right, and just squeezing in one final question on the fees. So you don't have a management fee; you have a performance fee. Obviously, this works well for the manager in rising markets, but maybe that's a challenge in falling markets. Is this fee structure under pressure? Would there be any plans to change the fee structure?
Yeah. So that was when we launched the trust in 2018. We saw that most of the trusts were charging a fixed management fee, and there wasn't a lot of alpha to talk about. Most were underperforming, not even meeting benchmark returns. And we've had a long history of managing money in India. Like we said, it's a market where you can actually extract alpha if you have the right infrastructure in terms of research team, in terms of philosophy, process, portfolio construction. So we're quite confident that if we get these elements right, there is alpha to be extracted from the Indian market. And that's why we have built a very shareholder-centric fee structure. We are measured on a 3-year period, right? So our performance fee is not linked to a 1-year performance. It's linked to a 3-year performance, which we think is a reasonable enough time to assess performance. And this is based on pure alpha or outperformance. It does not matter whether it's a rising market or a falling market. Whatever is the alpha that is extracted, the manager gets paid on that particular alpha. And most of our investors have actually, the feedback that we've gotten is they really like this alignment of incentive structure. We don't make any money if our investors don't make money. And we only make money if our investors also make money in the form of alpha from the market.
Excellent. Well, I think that's all the time that we have. Thanks very much, Ayush, for your presentation and for fielding all those questions. It's very interesting. And thank you to everyone in the audience for your attention. And hopefully you'll join us tomorrow where we will be discussing Vietnam. So Have a great afternoon to everybody, and thanks once more, Ayush. Goodbye.
Thank you, everyone. Bye-bye.